New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is tax season. And we know everybody's out there with all their stuff, and they're wondering about how to get it done. And this is your time to get free information. I'm Esther Gulius, Tax Lady from EG Tax with Christopher Fabian.
Hello, Esther.
And we love the snow, don't we?
It's my favorite time of year.
Yeah, right. If it gets any more, I'll tell you. But my clients, Stephanie and Everett, are on their way to Sanibel Island tomorrow, and I told them that I would be their baggage handler, and they won't take me. Anyway, we got all of our offices open tonight, 9 to 9, Monday through Friday, 9 to 9. And this is really, the next 2 weeks is the busiest 2 weeks of tax season. So if you aren't getting help from the IRS, you can go to egtax.com, and we'll be very happy to help you with your tax questions at no charge. The other thing is, those of you that are calling in, 803-0930, 803-0930, star 930 on a cell phone. It is Jay, our telephone screener guys. 10th anniversary with WBEN, and we love Jay. Yeah, Jay!
Hey, Jay!
Jay! And everybody has to wish Jay happy birthday,
happy anniversary. And he wants the lines lit up.
He does. He wants, because he's been sitting around today kind of slouching, so we want to get Jay so he really feels important, right?
That's right. He should come to our office.
That's right. And for those of you that want to call from out of the area, Florida, Arizona, Toronto, Canada, 1-800-616-WBEN, 1-800-616-WBEN. And so we're going to talk about today, before we get to the phone lines, errors people make on their tax return. And I was thinking about it, and I thought one big error, and I know people are making this error, is that, on the 1040, right, Chris, it says state refund.
Yep.
And so you look at last year's return and you put on your New York State refund that you got, and you think it's taxable. But it isn't necessarily so, right?
Not necessarily.
So you have to, number one, if you itemize.
You have to itemize, but use your state withholding as your state tax paid.
Right.
Not the sales tax.
Right. And so when you take a look at your refund that you got last year, you have to reduce it by any credits that, first of all, you had to itemize.
Yep.
And your itemized deductions had to be large enough that you actually got a benefit that's larger than your refund. Then secondly, the refund is reduced by credits.
Yep.
So let's say you had well, I'll give you an example. Let's say that somebody had a refund that itemized last year of $1,850 from New York State. They had 3 kids under the age of 17, so they got the Empire State credit of $990, and they got the education credit of $400. Then that you would take the $990 and $400 and take it from the $1,850, and what you find out is only you're not going to include the $1,850, you're going to include $460, and that saves you as much as $471 in income tax. And that's a simple thing, but it's a calculation you have to make.
You got to be careful. That's a big mistake. And you can't, if you had a balance due, you can't put a negative on line 10.
That's right. And the balance due is also
an itemized deduction.
Yep. So the thing is, if you find out that you've been including your New York State refund as income on your federal return, and you never looked at your credits, and you have credits that you got on New York State, refundable credits, you got money coming back. Right? And you can amend up to the last 3 years.
Yep. And I know the people in Florida right now are going, what state?
Who cares? Yeah. Who cares? We don't pay taxes. But you did when you lived up north. And we're up north, and it's cold, and it's warm for you, and we're going to help people. And the other thing, not adjusting your cost basis on stock by reinvested dividends. Now, what does that mean?
It means you have a mutual fund, or we'll even say M&T stock, and you reinvest the stock every quarter. Instead
So
of getting your
the
check,
money, you let them hold
you
it.
let them buy more and more
You
stock.
let it ride.
You let it ride. And you started with $10,000, and your dividends were $100 a year for the next 10 years. So that's 100 times 10. That's an extra $1,000. Your basis is actually $11,000, not the $10,000
All right.
of the original
So I got
purchase.
an example. Let's say somebody had original stock they bought in 2000 of 30,000.
Yep.
All right, and for the last 15 years, 14 years, you've been having taxable dividends of $1,000 a year.
Yep.
They put them on your tax return, and you let them ride. So easy math, that's $14,000 of accumulated dividends. You have to add that to your stock. So now your real basis is $44,000. So if you sell that stock for $40,000, you actually have a $4,000 tax loss.
Yep.
And it would save this person approximate savings of $3,000. So that's really, really, really important that you keep track of your reinvested dividends, right? I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Don't forget to say happy anniversary to Jay, and we're going to go to Paul in East Aurora. Hi, Paul.
Hello. So I have probably an unusual question.
Yeah.
Had a property in another country, and somebody used identity theft and sold the property with falsified documents. And we spent a couple $1,000 in legal fees and private investigators and tried to get it back, and there doesn't seem to be any way. Can we deduct that loss?
Okay, so was that property investment property?
No.
What was it for? Was it?
It was another home.
No, but it was your second home, correct?
Yes.
Which
right.
certainly you didn't buy it to lose money. You bought it as an investment, I'm assuming.
Right.
So if this were investment property, right,
Right.
and he's taxed on worldwide income, then, well, first of all, can you substantiate that it was stolen?
Oh, yes. We have. Well, then the thief is in jail right now, but.
And they won't. Well, and at any rate, if you can substantiate that it was stolen, then
You have
a
two
law-
options.
right,
You can do a Schedule D loss
or a casualty.
or a casualty loss on your itemized deductions.
Right. And I think you're going to find that the Schedule D loss will be more money, but is limited to $3,000 a year.
You'll get it longer
right.
than
Yeah, you get a little bit at a time over a longer period. So yes, it's one or the other, but you've got to make sure that you can substantiate everything you've done to show what you've done to get the property back.
And are you going to get any of the money recouped that he sold it for?
No, doesn't
Yeah.
look like it.
Well, and if you're in the 15% bracket and you lost $100,000, God forbid, at least you get back $15,000 from the federal government.
Okay.
All right?
All right. Thank you.
Thanks, Paul. Sorry to hear it. I'm Esther Golias, the tax lady from EG Tax. We're going to join you on the other side. We're going to take a short break. Okay. I do not know, Tyler, what could that be?
That is group love.
Group love. Group love.
Okay.
Well, we love everyone, and so that's group love in a different way, I'm sure. I'm Esther Golias, the tax lady from EG Tax. We want to help you, so get those 1099s and W-2s and all your health care questions, and come on to the phone, 8030930, 8030930, star 930 on a cell phone, and out of the area, 1-800-616-WBEN, and we'd love to hear your questions. But we've been waiting. Roz has been waiting a long time. Hey, Roz, how you doing?
Hi, Esther. Thank you so much for taking my call.
Yeah, what can we do for you?
Actually, I had surgery last January, and I have no health insurance at this point, but I have over $5,000 out-of-pocket expenses, and I would be able to deduct that, correct?
If
Well-
you paid him. Unfortunately,
Yeah,
sorry, just to jump out like that.
I'm sorry, could you repeat that?
If you have to pay them in order to deduct them,
Right. They have been paid.
they have been paid.
And you
Okay.
can itemize. So there's a
Yes.
it's a double whammy. Are you a single lady or married?
I'm single.
All right. So your standard deduction is $6,200. Okay.
Okay.
So you have your $5,000 in medical, and you think, oh, this is great, except, and it's always the exceptions in the tax law. you have to reduce your $5,000 by. Are you under the age of 65?
Yes, I am. Just under.
All right, then you have to reduce that $5,000 by 10% of your adjusted gross income. So if your adjusted gross income is $40,000, you have to take $4,000 from the $5,000. Now you only got $1,000 that's deductible.
But yeah, don't forget though, it's not just your surgery, it's your doctor visits throughout the year, it's your prescriptions, it's your dental, it's your eyeglasses, I mean, your mileage back and forth. So there are a lot more things involved.
Yep.
Okay, yes, I have all my receipts from
So you got to add it all up. So add it all up. Then you have to take 10% of your adjusted gross income from that. Then what's left becomes an itemized deduction. Then you have to take your state withholding or your sales taxes, whichever are greater, your property taxes, your mortgage interest if you have any, charitable contributions, casualty losses, business expenses, and if that all comes up over $6,200, you win.
Very good. Well, I have an appointment next week at your office, so I will bring all my paperwork.
All right, we will take really good care of you, Roz.
Okay, thank you
dear.
So much, Esther.
All right, bye-bye. I'm Esther Gulius, the tax lady who's lost her voice. 8030930, 8030930, star 930 on a cell phone, and we're talking about common errors people make on their tax returns, right?
Yep.
All right, including your kids' wages on your tax return, right?
Yep.
Parents don't know.
Yeah, you have an 18-year-old who works, and you think, oh, I'll claim my son, so I have to claim their income on my return.
Right.
And definitely not.
Nope. And so if you have included your children's W-2s on your tax return in the past, you have 3 years to amend it and get your money back. Your kid files his own return, even though you're claiming him as an exemption. So, for instance, if you have a 17-year-old child that makes $3,000 and you include their income in your tax return, it can cost you an additional $1,000 or more in taxes. So you want to make sure that you amend that tax return.
Yep. I mean, because you do that, you could eliminate the child tax credit potentially, start to get phased out. Your education credit could be phased out. There's so many different things that could affect the tax. How about your earned income credit? You may be able to lose some of the if you're doing that.
That's exactly right.
So.
That's exactly right. All right, another thing that let's see what else I got. Oh, not claiming the education credit and giving it to your child in college. So here's an example. Let's say you have a child that makes $5,000. And the parents say, and the kid says, I want to claim my own education credit. All right. So the parents allow the child to take the American Opportunity Tax Credit. All right. And the child has $8,000 in tuition. Well, the child's going to only get a $1,000 refund. If the parents, on the other hand, claimed it, the parents would get an additional $2,500 refund and an additional $400 on New York State. So which would be a total savings to the parents of $2,900. So in essence, the family would do $1,900 better by letting the parents claim the AOTC. And it's just much easier to give the child $1,000 of their $2,900 savings.
Yeah, and actually, the child isn't eligible for the $1,000 refundable credit.
Right,
because
but you know what happens?
They don't mark the box.
Right,
so
and that's the reality. All right, another thing is not taking advantage of the pension savers credit, and this is something you can create right now when you're doing your own return, right, Chris?
Yep. That's like another one of our mistakes is not taking advantage of the retirement account or an IRA. What you can do right now is you have to April 15th to put money in an IRA for last year. So the government can give you a 10% up to a 50% credit depending on your filing status and your income. So if you put $2,000 in an IRA, you could get maybe $1,000 credit up to your tax liability. So they're actually giving you money.
50%.
Yeah.
And then, so you can actually, I just was doing this yesterday with a lady that was in my office. I did it today, as a matter of fact. She doesn't have a pension plan at work. And her income was relatively low, around $15,000. So I knew she was going to get 50%. So I said, why don't you put $1,000 in the IRA? And with your refund you're going to get on your federal, which is going to be in the end of the month, take that money and fund your IRA, and they're giving you $500 extra
between
back.
the federal and the state, she probably only had to come up with like $360 of her own money.
And so it reduced her tax liability on her federal, reduced her tax liability on the state, and the federal government was kicking in half of what she's putting in.
Yep.
And so it's just remarkable. And even if, like somebody says to me, well, what if I need the money? It's there. You technically could take it out next year, and if you're in the 10% bracket, it's going to cost you 20%, right? 10 and 10 on the 1,000, which means you pay back 2,000. But they gave you $600, right?
Yeah.
So you made out by $400.
Yep.
Right?
Yep. I mean, I saw someone use it to get extra money for a down payment on a car.
Yep. It's true. So, and those are just some of the things that people do that they don't know the angles, and it's a very angular system. The tax system is a very angular system. I'm Esther Gulius, the tax lady. Join us here in studio if you have any questions. 803-0930, 803-0930, star 930 on a cell phone. And our toll-free number is
1-800.
Oh, you know it.
1-800-616-WBEN.
All right. Now, what else? Then we have, okay, so my example here with the pension savers credit, a couple age 58 with income of $32,000 from pensions and a part-time job of $5,000 have a tax liability of $1,173. But by opening a traditional IRA in the amount of $2,000, they save $1,173 in taxes. And I mean, and so especially somebody that's a little older, they might have money in the bank account, right? Yep. So just by moving it from shelf A to shelf B in the same bank, they create their own deduction. And in this person's case, they'd have to wait a year and a half to take it out without penalty, right? Because they're 58.
Yep. So, I mean, you like you said, look at the angles. Put the pen to paper and do the math. The whole and you got to know taxes.
Well, that's the whole thing. People don't even know what's available, so they can't put the pen to paper. All right, so here's another one. Not getting the premium tax credit. Now,
what's the premium tax credit?
That's a brand new thing this year with Obamacare. So by not using the marketplace, let's just say, for instance, that you are on a COBRA plan through your employer, and you just kept paying after you lost your job, but you could have gone to the marketplace to get insurance.
Yep.
And it's Blue Cross Blue Shields, it's Independent
Fidelis,
all the same insurance companies that are represented in the marketplace. But when you go to the marketplace, that gives you the opportunity to potentially get the premium tax credit, which means that if you're paying it yourself and you were entitled to a government subsidy, but you didn't take the subsidy, they give you a refundable credit. But it only works if you're in the marketplace.
Right. You have to go to the NY Health.
It's New York State of Health.
Yep. You got to go through their website.
Or
we call it the Tiki Barber website because the gentleman holding his kid looks like Tiki Barber for the kids, guys who remember football.
Or if you're in Florida, you would go to the
fed.gov. At the federal website.
Yeah, great.
I don't remember it.
We need to Google it.
Yeah.
We need to Google
it. But,
I
mean, you got to go to the marketplace, and you could be literally costing yourselves thousands of dollars. But what about the people who could get free Medicaid? I don't want the government to know my business.
Oh, that's true, too. And the whole thing with the Obamacare thing is that there is a way to get free health insurance. Like it or not, you may not agree. I don't agree myself with many situations because it's redistribution of income, and we won't even go there. But the truth of the matter is, if your income and you're a single person is under $20,000, pretty much you're going to get Medicaid, free health insurance.
Yep.
And if you don't, and don't let because you don't know how to get it be your crutch.
Yeah.
Because we'll help you.
We're here for you. And, and the thing is, too, you got to look at the individual plans. Don't just go for the cheapest because there are 4 levels, the bronze, the silver, the gold, and the platinum. You got to look to see what your family out-of-pocket maximum is. I had a couple this week come in and, we went with bronze because it was cheap. Well, she ended up with breast cancer. $12,000 they got to pay out of their pocket. Because
of the high deductible.
High deductible, maximum out-of-pocket. So what they would have saved by going a little bit higher, I mean, yes, it's a gamble. Any insurance is a gamble. You're gambling on the negative side of you.
But then by the same token, if you think about it, let's say you had a bronze plan. Why don't you move up this year to platinum?
Yep.
Because everything cancels every year, right?
Yep.
So what they ought to do, looking at the possibility, and this is just, again, something that people need to look at when you're looking at angles, God forbid you found out that you did have a serious problem with your health and your family, and you were in the bronze plan. What you should do is cancel that plan this year and go up to the platinum because it has zero copays.
And they can't turn you down because they're pre-existing conditions. They can't disallow that anymore. Sorry.
That's exactly right. And I will tell you, if we have a navigator that works right for EG Tax, Tim Eliason, at our Lockport office, and he will help you to navigate the whole Obamacare situation. I'm Esther Gulius, the Tax Lady. We're going to take a short break. Join us on the other side, 8030930, 8030930, star 930 on a cell phone. We want to hear from you. All right, Chris, who is this? I like it. I know who this is, but I can't think of his name. All right, who is it?
It's the Heavy.
Oh,
I would
Car
have
commercial. It was like with the dancing, animated
like
characters in the back seat of the car.
Oh, my.
Okay.
Well, I'm Esther Gulius, the Tax Lady from EG Tax, and we do taxes, and we certainly want to help you. And I will tell you, this should be everybody should have all their stuff mostly, and our offices are open tonight 9 to 9, all next week 9 to 9, and we will help you. And if you aren't getting through to the IRS, because statistically I guess only like 34% of all calls are answered, and they have to wait a half hour or something because there's not enough people working at the IRS, EG Tax will help you, right?
Yep, most definitely. And if you want your taxes done tomorrow, our McKinley Mall office.
That's true. We do close on Sundays because it's our day of rest, but we do stay open at the McKinley Mall because we have to comply with mall hours. So you can go to the McKinley Mall.
That's right. So visit them, say
hi. And we got offices that go all the way from Medina, all the way down to Wellsville, right?
Yep.
And everywhere in between.
Batavia to...
Right. Naples. We're there in Naples on the airport road across from... Tamiami Ford, which I would really like to do right now is go to Florida
and buy a car.
Very good, and it's unbelievable. Tyler was just telling us it's going to be a low of 4 next week.
Low of 4, yes.
Ugh, I just hate it. And Florida, listen
negative
to this.
4 was
Look
negative 4
Florida,
Thursday night, yes.
It's going to snow 2 inches a day every day next week. That's what Tyler says, and we already have 10 feet of snow on the ground. I mean, it's like, you can't believe it.
Get your milk and bread.
My parking lot is like a lady getting fatter because it's getting, she's hardly can fit in because it's getting smaller and smaller and smaller and smaller and smaller. Right now, it's a 15-car parking lot, and I think we're going to get 2 cars in here pretty soon because there's nowhere to put the snow.
And poor Jake, who's from Florida, is out there trying to snowblow.
That's right. Jake,
I think he likes snowblowing.
Jake Sheldon is from Florida. He's up working at an EG Tax, and he's out there snowplowing.
Some guy went up to him yesterday or the other day and said, "Where's your hat? Put your hood on." And put the hood on, and he left it on all day. I think he was afraid to get yelled at again.
I'm telling you. I'm Esther Gulius, the Tax Lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. Okay, back to things that people do that is not such a good idea. All right, for you people in New York that have a pension, all right? Your pension, if it's a New York pension, if it's a city, county pension, federal pension, your pension postal is completely tax-free on the state. No, regardless of your age. So if you have a pension and you haven't been backing it off, you've overpaid Andrew Cuomo.
Yep. And, if you're a New York State firefighter or policeman, and your health insurance is coming out of your pension, the first $3,000 is a subtraction from the federal too, automatic right on page 1 of the 1040.
That's another thing people miss. The other thing is,
well, if you're not in a government
right,
pension.
If you're not, like if you're just a normal person with an IRA and you're not connected to the government in any way and getting a pension, and you're over the age of 59 and a half, the first $20,000 that you receive in pension from yourself and your spouse. So $20,000 up to $20,000 for you, up to $20,000 in your spouse. So potentially you could write off $40,000 in pensions and IRAs on the state return.
Yep. And how about a death benefit? If you receive a death benefit from a pension or an IRA, and that person was over 59 and a half, that
passed away.
Yeah, that passed away. That $20,000 flows on to the beneficiary. So if there's only one beneficiary, that person can eliminate the first $20,000. But if there's two, each one would get a $10,000 exclusion on New York State return.
Right.
And that's a big mistake we see also.
All right. And then the other thing is, and by the way, if anybody does want to call us, I don't know where everybody is today that they're not calling, but 803-0930, 803-0930, star 930 on the cell phone. This blows my mind because usually
our phones lines are lit
during
up.
tax season, everybody's on the phone and nobody's calling us. And Jay, it's his anniversary and nobody's calling him. It's Jay's fault. Must be nobody wants to talk to Jay.
All they have to do is be nice and say, hey,
happy anniversary, Jay.
We're really proud of you.
Okay. Not putting money into your pension. Now that's something that you need. Oh, look at this! Everybody's calling in. All right, if you have a company pension and you don't contribute to it or are in it, and especially with an employee match, is that stupid or what?
Well, the employee match, first of all, employer match, is phenomenal because if you don't do it, you're throwing away money. Because if they do 3% match of your salary and your salary is $50,000, you just gave up $1,500 free money.
I'm telling, and really, you just have to be in it to win it. You know. So let's say you say, well, I can't afford to put money into my pension, but let's say you put in $50, so you're in the plan, and the employer wants to do a 3% match. He's got to do
the $50 up to your $1,500, whatever you put in.
And if you put in $1,000, he's got to put it up to $1,000.
Yep.
I mean, it's free money.
Yep. And and people go, does a 401k really help my taxes? Do I really want to put money in there?
You betcha. Okay. Well, people heard the call and they are on the phone, so we're going to go to Walt in Amherst. Hey, Walt.
Hey, Esther.
We were feeling, Chris and I were feeling very depressed that nobody was calling us. What can we do for you?
Well, I felt bad for you, so I figured
I'd
call.
Oh, you're a sweetie pie. Thank you.
Actually, I'm calling because my father had passed away last year, and I had asked my mom when we were going through all her financials, I said, what are you doing about filing your tax returns? And she says, well, we were told we didn't have to file tax returns, so looked into it further, and she hasn't filed tax returns since 2004.
But you know what, Walt? If Mom and Dad were filing a joint return, so their standard deduction is $12,400, plus being over I'm assuming over 65. That increases their standard deduction, plus their personal exemption. So till they're around $21,000 in taxable income, they don't necessarily have to file. Was Dad working?
He was working at the SPCA for years, and then when
in recent years.
Oh, no. The only thing that they have as far as their income is Social Security and $600 a month from their 401k.
No, Mom and Dad don't have to file.
Oh, good. So they're safe.
That's right. And you're a good guy for helping your mom.
Well, thanks. I appreciate that.
Thank you. Sorry about your dad's death. Bye-bye.
Thank you. Bye.
And that's a major life change. And with what he said, even though next year, because in 2015 Mom's tax situation totally changes.
Right.
She now is single, that income still isn't enough to file a return. So she's still safe from that point on. But when that happens, you really got to relook at the whole picture and see.
That's exactly right. And we're going to go back to another person who had pity on us, is Bill from Elma. Hey, Bill.
Hello.
How are you?
I'm so doggone good, it's scary.
Oh, that's wonderful. I'm glad to hear that.
Okay, I have an easy question, maybe.
Yeah.
I'm retired. My wife is retired.
Okay.
We both get Social Security and some small pensions.
Okay.
But I don't have any earned income at all. I don't have a job or a part-time job or any of that.
How old are you, Bill?
67.
Okay.
And I would just like to know, is it still possible for me to make any contributions to my IRAs, or is that dead?
Well, without working and without having earned income, yeah, unfortunately, you can't do that.
However,
Yeah.
what if you got a job?
If you got a job, then you can.
Right.
Okay.
Now he's not in a good mood anymore. You told him to go get a job
Right.
again.
No.
Up to age 70. Up to age
Actually,
70 and a
I'm
half.
in an extremely good mood,
Okay.
and my reason is that I write science fiction novels.
Ah.
And as fate would have it, I'm going to have them published,
Good for
and
you.
but that's going to be future income.
Right.
And it puts me in the category of I've got expenses in 2014, and I will have expenses in 2015, but I will have no income until 2016.
Okay, but the interesting thing is, Bill, even, I'm assuming you're going to get published.
Yes.
But the money you make off the sale of a book is called a royalty.
Right.
And a royalty is not earned income.
Doggone, you could have fooled me.
So
it's going to feel real good.
I know,
It's
but
gonna
the thing
spend
is,
just
earned
like
income.
Earned income.
Their royalty income is like rental income, and it's not subject to FICA, and so it also won't help you to do that IRA contribution.
Son of a gun.
Son of a gun.
And you know what?
What?
I'm still happy.
I'm glad. And so you go back to those people from outer space and whatever you're writing about. I happen to love your kind of novels. So if you get a chance, drop me an email at egtax.com,
Okay.
and I'd like to pick up your book.
My website is
Yes.
www.5moons.org.
Okay.
And you can take a look at the books that will hopefully soon be published.
All right. Good enough, Mr. Bill. Thank you, sir.
very much.
Bye-bye. See, isn't it good that he called us? He got to plug his book.
Yes.
I'm Esther Golias, the tax lady. For those of you who's taken pity on us, we'll join you on the other side after a short break. 8030930, 8030930, star 930 on a cell phone. Talk to you in a minute.
How lucky can one guy be? I kissed her and she kissed me. Like the fella once said,
Ain't that a kick in the head? I know that one.
It's Bill Birchmeyer singing about
That's
Esther
right.
Golias.
That's right. Now that's Dean Martin.
Yes, it is.
Right?
Love
See, if you go back to the 50s, I'm really good. I'm Esther Golias, the tax lady, and we got a whole board of calls of people that have taken pity on us here and our snowy days. So we're going to go to Carol in Lancaster. Hey, Carol.
Yes.
Hi.
Hi. Here's my question.
Yeah.
I don't have a lot of income, and I'll just make the numbers simple. I took an IRA distribution. I'm almost 69. Okay. I took an IRA distribution of $8,000. Out of that $8,000, I converted $3,000 into a Roth, and then I have my Social Security, which I believe was around. We'll just call it $9,000. So I did file. It seemed to say I had to file Form 8606, which I did. The question is, do I have to keep track of a basis on this?
On your Roth?
On the conversion, yeah. And if so, why?
Well, because it's got to be in there for 5 years. So if you take it out sooner than the 5 years, the growth is taxable.
Right.
It would be just the growth part, though, right? Because the other part...
But you see, Carol, what happens, the 8606 is the official form that says this is a partially this is a non-taxable plan. And so the IRS, when you say you've taken it out of your Roth, if you're managing...
No, I took it out of my regular IRA.
No. If you ever make a distribution and you didn't do the 8606, then you wouldn't have proof that it was from a non-taxable plan, unless your broker is keeping track of it.
But I had to show the full amount as taxable because
right. The whole $8,000 is taxable, but you're not going to pay taxes on it.
Right, I only pay taxes on.
You're not paying tax on anything.
You're not paying taxes on it at all.
Right.
All right. So the 8606 is just a way for the federal government to keep track of that money that's already been taxed, so that you're never taxed on it.
Okay, that's the thing. So do I have to keep track of a basis on that?
Yes.
Yeah.
Yes.
So what part can I take out? In other words, if I wanted to take it out,
you could take out your basis.
Right.
I can take out the base.
Yep.
Right.
So now, if you're talking about already taking it out, why are you putting it in already? Because you could just put it in a bank account and not worry about it.
No, I didn't take it out. What I intended to.
You took out of your traditional.
Yes.
All right. What Chris is saying is, if you really don't have an estate, do you have a large estate, Carol?
No.
Right.
But I would.
So when you put it in a Roth,
on.
which you're skinning the government out of any growth, and that would be about it. But the $8,000 you took out is completely tax free, and there's a lot of people listening that have IRAs that they could take out completely tax free. And he's saying, why even put it in a Roth? Why don't you just put it in a bank account? And then with your income limit, that's still never going to be taxed. So he's wondering why you would do that.
Yeah, you would get taxed on any.
But you know what, Carol? You don't have enough money to be taxed. You're never going to be taxed. And so if you just keep it in a bank account, you're never going to pay taxes on that money. Or if you put it in the investments, you're not going to pay taxes on the money. So that's why Chris was asking.
Okay, but on the basis part, the basis is the amount I converted, and then that
the $3,000 you converted. The other money you took out, the $5,000, is just your money.
The other money that it will grow to, that part, it has a 5-year thing. Is that the idea?
That's right. You have to keep it in the Roth for 5 years for
years.
the growth to be tax-free. But, Carol, in your situation, it's always going to be tax-free. So, and that's really all that we're talking about is that when somebody has low income, up to the standard deduction and personal exemption, they're not going to pay taxes anyway.
Right, and that's a common mistake. Speaking of common mistakes, putting money in a Roth when you shouldn't.
Right, because many people, like for instance, many seniors are not going to pay taxes until they get to $21,000 or $22,000 as it grows. And so they have money that's sitting in an IRA, and if they took it out, the truth is they wouldn't pay any taxes on it. And the interest is so low, they wouldn't pay taxes on it. So, well, are we going to go to Gary? Hey, Gary, how you doing?
Yeah, very good. Thank you for the show. My son, 29 years old, and he did not file for taxes 2013. Is he losing out on anything?
Maybe.
He didn't make a whole lot of money. He was like a waiter and a couple other jobs.
What do you think he made, Gary?
I couldn't really tell you. Maybe.
See, but the thing is, whatever he's 29, and he had earned income. So if his income was under $10,000, and it sounds like it was, right?
Yeah.
He had an earned income credit coming. And so if he doesn't file the return, they get to keep the money.
Right. How much would that be?
Could be about $320.
Right.
And any other?
And plus his withholding.
Yeah, and his withholding, and he gets a 30% of that on New York State too. So yeah, he should file. I mean, really, when you think about it, you don't file, and you don't have to file, but they want to give you money, so your son should get that return in.
Okay, another question. You guys are talking about the investor's incentive for investing in the IRA.
Mm-hmm.
Does that hold true for a 401k?
Yes, the Pension Savers Credit does hold true to a 401k,
right.
403b. Yes.
Okay, so if we put it in 2015, would that apply for the next time we do taxes after this?
Yes.
Yeah.
Yep.
And but one of the good. You mean for your son? You're talking about, or your son?
No, this is for my wife.
Yeah. Sure.
So we wouldn't get a refund.
Okay, but you remember, we were talking about the pension savers credit is for people that have lower income. So I don't know what you and your wife's income is, but if it would have to be for somebody with lower income.
Oh, so what would that be? What's the
married? I want to say 60.
About 60,000 and under.
Oh, and that's before taxes, after?
That's your AGI.
Yeah, it's 60,000 married joint.
Oh, joint, but gross?
That would be your AGI.
Your bottom of page 1 of the tax return.
AGI. Okay.
Okay.
All right, appreciate it.
So make
Thank
sure
you very
your
much.
son gets that tax return done, okay?
Yeah, and like you said, if we put it in this year, it'll apply to 2015 taxes.
That's exactly right.
For the IRA.
That's
or
exactly
401.
right.
All right, great.
Thanks, Gary.
Thank you.
Bye-bye. And we got Frank. Hey, Frank, how you doing?
Hi, how are you today?
Good. What can we help you with?
I have got a question about the dreaded Box 14 on the W-2.
Yeah.
So my wife works 2 jobs, and she gets W-2s from 2 payroll companies, Paychex and ADP.
Mm-hmm.
And on the Paychex W-2, she's got Box 14 amounts for New York SDI, which is her disability.
Right.
On the ADP, it's listed as voluntary disability.
Mm-hmm.
And the program I use to file treats these 2 differently, but I'm thinking they actually shouldn't be.
Well, it depends. On her second job, does she pay money for like a AFLAC policy?
No, it's a very small amount. She hasn't worked there long, and they take about $1.30 every paycheck. She
like
grosses about $450.
Is it
sure
weekly or biweekly? She gets paid.
That's twice a month.
Okay, so yeah, that would probably be the SDI.
Which she should just double check that it's SDI. Ask her HR department because it's an itemized deduction.
Right, and that's what I was figuring it would go into. It doesn't really affect my actual tax, but going forward, I know it's going to be a larger amount in the future. I just think that the voluntary designation in the Box 14 may be wrong.
Well, I mean, what she should do is talk to the HR department and make sure that it's New York State SDI.
Okay.
Okay.
Is there any reason that that's placed like that?
No, because you know what's interesting with payroll companies, you find, and there's no standardization, unfortunately, in a W-2. You'll find different payroll companies do different things. The important thing is, in the event of an audit, that you're doing the right thing.
Right. Okay. Well,
all right.
Thank you very much.
Hey, thanks for the call. Bye-bye.
Bye.
And we're going to Gary. Hey, Gary, how can we help you?
Great, Esther. How are you?
Good.
Great, Esther. I own a small business, and I make a good income. I max my 401k to the complete amount. Do I have the ability to also fund either an IRA, traditional or Roth, or is there any other tax-privileged vehicle that's available to me?
It all depends on what your AGI is and your filing status.
Yep. So let's say let's say you're maxing out your 401k and your income is $50,000. Then that's a horse of a different color because you can put money into an IRA too.
Yeah, it's higher than that.
Okay, so but
is there a top-end limit?
Pardon me?
Is there a limit? In other words, there's a certain income limit?
Yes, when you're covered under a pension plan. Are you single or married?
Married.
All right, it's 96 to 116,000 the phase out on a traditional IRA.
I see. So if you're above that, you cannot do both.
That's exactly right.
Does your wife work?
She does.
Okay. Does she have a... Sorry, go on.
And she maxes her 401k as well.
Okay. No. Then that's it for you guys. Now, what do you... So are you a small business sole proprietorship or...
S-Corp.
S-Corp. Single owner?
No, multiple.
Okay. Then, yeah, because I was going to say because you could do a solo IRA, and if you did a solar IRA, you could put $52,000 away, unless you did a defined benefit. And if you changed to defined benefit contribution, you could put a lot more than that away.
Explain to me that defined benefit.
If I only had an hour, but I got 2 minutes, but you can call, email me, Gary, through my website at egtax.com, and I'll give you the parameters.
Great. Thank you very much.
Thanks, Gary. And let's go to Dave in Tonawanda. Hey, Dave.
Hi.
Hi.
I have a question. I started paying my own medical payments myself last year.
Okay.
I paid about $17,000. Does that include my dental premiums too?
Yes, sir.
And any like co-pays and
all your co-pays, glasses, dentists, doctors, mileage to seek medical attention, ambulance, hospital, trusses, braces, crutches. If you needed, if you have a special medical condition and you needed a hydrotherapy, a special tub, special grip rails, all of that's deductible.
Oh, I didn't know about the eyeglasses too. Okay.
Yeah, everything.
And so what is only 10% of your?
You reduce if you're under the age of 65, you reduce it by 10% of your adjusted gross income, and the excess is what's your itemized deduction.
Oh, after the adjusted gross, like after my property tax and so on.
No. Page 1 of your 1040.
Right. Okay.
Okay, I got another question. My son.
Hey, Dave, I'm running out of time. Write me through egtax.com, okay?
Okay,
Thank you, sir. I'm Esther Golias, the tax lady. We got all of our offices open 9 to 9. We'll want to help you with the best tax help for the most reasonable fees. Until next Saturday, or when you talk to us at the office, I'm Esther Golias and Chris Fabian.